Hey harvesters, and welcome to the channel where we sell options to generate income. My name is Matt, and in today's video I'm going to talk about the harvest plan for the remainder of 2025. We have 3 trading days left. We have Monday, Tuesday, Wednesday. Thursday is the new year, January 1st. That is a non-trading day. The markets are closed, but then the first trading day of 2026 will be Friday, January 2nd. So we're going to talk about all the covered calls and the cash secured puts I plan on running for next week so we can generate some income. I'm shooting for the 4-digit club, $8,000 or more, but we will see what the market will give me. I'm going to talk about, most importantly, I do want to talk to you guys about 2025 and the reflection. Some hard decisions were made in 2025 because I initially started off 2025 investing into high income ETFs. Everything was going relatively okay until the whole tariff time, liberation day, whatever you want to call it, drop in the stock market about 18%. And so initially I was invested in those high income ETFs. When that drop happened, what I observed, and I was comparing the S&P 500, so SPY and QQQ, for every 1% the SPY or QQQ went down, the high income ETFs were going down 2.5 to 3 times as much. So 2.5% or 3% for every 1% it was going down. I'm like, how is this sustainable in any way? And then once I started thinking about the entire time I was invested into high income ETFs, it's the poor man's paradigm where you don't have enough money to invest into the good investments. However, by you seeing that you're getting a distribution every single week, you're excited for it. You're like, oh, I'm making a ton of money, but then that money isn't really usable because most of it is being pulled from the share price to then pay you back. And then the only way that the funds actually get more money is investors putting in more money so that they can pay out the distributions. And so for me, I did not like the NAV erosion. I did like the payments. They were quite exciting, but they weren't what I thought they were going to be. Over that time period of me investing in high income ETFs, my account really didn't grow much. So what did I do? I made the executive decision, and that's why I have my first options trading video of when I sold out of all of my high income ETFs to what I am trading now. At that time, guys, look at where my account was at. $88,000. There's no 1 in front of it. It's $88,000. And I think even in my spreadsheet, it's a little bit lower. It was like $86,000. But when I made the video, it bumped up a little bit because I started doing the selling options. But it was at $88,909. And so for me, this was a scary moment. I sold out of every single investment I had over the last year and a quarter period. So it was at like 14 months, 15 months. And I decided to do a hard reset. Why? Because my account suffered big time. So let's take a look at Robinhood real quick. Right now, you guys can see my Robinhood is $233,000. All right, let's take a look at how much money I've made in the last week. $3,600. Some of it was premium. Some of it was just my shares I'm invested in going up. Look at the last month, 4.85%. So $10,000. Last 3 months, we're up 15.55%. Let's take a look at the last year to date. So the last year to date, I'm still up 15.21%, up $30,871. But guys, here, this is what I wanted to explain with the high income ETFs. The growth was very linear. I was getting the payments, but then the second the market started, transversing in the incorrect direction, I think Trump got elected or in office January 20th, and then started talking about tariffs, and then the hedge funds started pulling their money out. And it was just a slow, trickle down eventually to the point where April 8th, I'm like, I have enough of this. I had enough of it. The stocks kept going down too much. And eventually my account went down to $138,000 of investing. But then at this point, April 8th, I did capture a nice big bull upside. From April 8th all the way until now, we almost increased about $100,000 in value, which is absolutely wild to think about. So for you guys in that same position where you're still afraid of selling out of something at a loss, it's okay. For me, I'm going to be able to tax loss harvest a lot of that, that redness. Basically, I realized that tax loss, nothing was washed out. And then all of my gains up, some of that is going to be tax exempt because I incurred such a massive loss, especially because of my taxable trader status. I've been trading a couple hundred times for this last year. I'm definitely going to qualify for that. So yeah, but now the account, $233,000 selling options. So basically what I'm trying to say, guys, is if I was afraid of, of stepping into the unknown, not selling my own options, I would still to this day be stuck with high income ETFs. My account theoretically could have been lower, or at least like the gain would have been capped. Or I decided to take that step. I'm like, you know what? I'm actually going to learn selling these options. How hard could it be? How hard is it for these hedge funds to run these options? So of course you start looking into buying the calls. I'm like, man, I just am so stressed out every time I look at those trades. I can't sleep. I'm looking at the charts too much. I'm like, there's got to be a better way. Eventually, I settled to the idea of just selling options, covered calls, cash secured puts, buy good investments, and then sell covered calls against them. Since I have been doing that, guys, I've made over $86,000 of realized gain. Basically, you guys saw the account from this $138,000, and we're blasted up to $233,000. Absolutely wild. And I'm definitely happy that I made that transfer, because if I was afraid, I would still be stuck in a very bad situation. And sometimes you have to incur a loss. A lot of people don't want to incur loss. They're going to wait for their high income ETF to come back. Guys, I'm telling you, it's never going to go back up. High income ETFs, they are not designed to gain appreciation or capture upside. They're just generating income. So yeah, that's all I have to say on there. If you're in that situation, I hope that you can find the strength to do it. I did it. I'm going to be able to tax loss harvest a lot of that loss from my gain, and everything is going to be okay at the end of the trading day. Just wanted to point that out. But now let's talk about the actual reason why you guys are here. You want to see what I plan on doing for the next week. But I will also say this, I'm definitely going to talk about some of the goals I have for 2026. I also think it's important that you have more than just financial goals. And so for me, heading into 2026, the number one thing on my list is get married to the love of my life, my fiance Nicole. If she's out there listening, babe, I love you. Ever since meeting her, having her come into my life, I have never been happier. I was a military guy, was always on deployments, always gone. Once I finally got out to the civilian world, had a stable life, I was able to find her, and she's the best thing that's ever happened to me. So I can't wait for that opportunity, and I hope that you guys find someone that also brings you that joy. But for me, I was looking for peace, and she brings me that peace. And my number 2 goal for 2026 is I want to get in better shape, because I was thinking about this and reflecting about this a lot, because we spend our youth trying to make as much money as possible, right? So we'll work those long hours, we'll grind, work, because you want to support for your family, you want to have a better life, or you want to have that nicer car. But then you spend the best and healthiest years of your life trying to make money. But then when it's finally time for you to retire, the only thing that you wish you had in your retirement would be to be healthier, so that you can go on that hike, so that you can go to your family's wedding, or go to a birthday party and be healthy and walk without assistance. And so for me, I definitely was starting to reflect on that a little bit more. So for me, I wanted to prioritize my health. Of course, I want to prioritize this channel, but ideally, I think I'm going to prioritize health and working out and making sure I'm running, I'm walking, all of that stuff. But then lastly, now let's talk about the financial aspect of this video. For 2026, I really have a simple goal, and because I really don't want to have a metrics driven goal, because I'm not, this is not a business. Trading is not a business, because I can say, hey, I want to make $1,700 a week, and hopefully I can generate that income. But that's complete BS, because nobody knows if the market is going to be green or it's going to be red. The hedge funds could randomly pull their money out and be like, oh man, this whole AI investment is not worth it. And guess what? They start selling out all of their shares. It's going to cause a market crash. Or for whatever example, say World War III happens. Those are like the only real 2 scenarios I see that market can go down in 2026, because I do think there's a lot of investment. I think there's a lot of optimism in the American market. So I think there's a lot more positive heading into 2026. So I'm still always bullish in American markets, but the looming war with China eventually, that's always kind of in the back of my mind. And then also just the AI investment. Is it worth it? Is it not? Those are the only 2 things I can see happen that would potentially bring 2026 down. But ideally, guys, I'm pro market. I'm pro America. I think everything is going to be just fine. But yeah, like I said, I'm not going to come up with hey, I want to make $100,000. I'm not going to come up with, hey, I want to make $1,700. What I will say is, for my system of trading, never sell below your buying point. and only buy good investments. That's the only thing I could really stay on top of. And the goal for 2026 is don't lose a trading day. So what does that mean? I don't want to have a negative day. I'd rather take no premium than realize a loss. And as long as I stay true to the rules I, emphasize, I think I'll be able to achieve that with no problem. So with that being said, guys, let's actually talk about my trading rules and some of the guidelines. All right, guys, here are my harvester rules for trading. And over the last couple of weeks, you guys will have noticed I've been modifying them, changing them, taking away rules, updating what I actually have inside of the rules. So what I did this week is there's really only two rules I like to live by. That's going to be buy good investments, number one, and then don't sell below your buying point, two rules. All of my other, steps, I'm considering them guidelines because I'm not really, hard line that you have to follow this to the T, to the dot, period. My two rules, buy good investments, don't sell below your buying point. Those are the two main rules I will not break. But then guidelines, there's always like a gray area in the guidelines. Sometimes an opportunity presents itself, you're going to trade a certain way, or it's another opportunity where, hey, market's showcasing this kind of condition, we're going to trade in a different way. So it's more of like a guideline, but it's not like a hard and fast rule you have to follow. That's why I broke it down into two different parts, rules and guidelines. So heading over to the first rule, guys, you know me, buy good investments. Most of my trading is done on the ETFs of SPY, QQQ. I will throw in some individual stock tickers. I usually like to choose the winners of today, top 10 stocks of an industry, or just top 10 stocks in general. I'm not a big fan of up and coming. Some people are going to come up with, hey, do you use leverage funds or use this? I already use enough margin where I don't want to use more leverage stuff. For me, I'd rather just buy the good investments, because the worst thing that happens if the market goes down, you hold on to the good investments and wait for them to come back. If you're into all that leverage stuff and, stocks that don't really have a, strong balance sheet, or they haven't been around for, a good long period of time, you're going to deal with what comes with those kind of stocks, pain and suffering. But I like to choose the winners of today. And one of my ways I like to explain stocks is, the stock market is capitalism, right? If the stock is priced very high, that means it's showcasing its value and somebody's willing to invest money into that stock. Versus if a stock does not have a lot of, market value or market cap, it's going to be lower in share price, which means that it's showcasing its value to investors. Not many people want to buy into it and invest into it and risk their hard-earned capital for it. So there's that trade-off. High stock price, probably a good investment. Low stock price, probably not a good investment. So, of course, finding the right stock. There's plenty of other YouTube channels that are going to explain that for me. I like to keep things as simple as possible. Winners of today, ETFs, nothing too crazy. Now let's go to rule number two. Rule number two is don't sell below your buying point. And this is very important. I decided to go a little bit further today, make a nice little beautiful PowerPoint slide. So I'm going to give an example of why I personally don't like to do this. This is a hard and fast rule. This is what I'm putting out. It's what I'm educating. This is all an opinion. If you don't want to follow it, that's up to you guys. But this is what I like to do. And that's helped me generate over, the last 179 trading days, over $86,000 of profit. So say, for example, we have the QQQ trading at the 625. We buy 100 shares of them. Buying 100 shares of QQQ at the 625 allows us to run covered calls. So now let's say we sold covered calls for a couple of days, a couple of weeks. Now you generated over $500 of premium. Great. That's awesome. That's exactly what we're trying to do here. Good investment, generating premium, rinse and repeat. Great. Your new cost basis for those, QQQ shares is now $620 a share. So that's how Robinhood operates. I don't know how Fidelity does it. I don't know how Schwab does it. I don't know how E-Trade or Interactive Brokers. However, I did use them for a little bit, but I've never sold options on them. So it's hard for me to say what they're going to do. And what Robinhood does, takes the share price, takes the premium, puts it together, and then lowers your cost basis. So that's why I'm showing here cost basis is now 620. This is great, but what does it lead to? Say now the QQQ market drops to $615 a share. So you bought them at 625. Now QQQ is at the 615. What is human instinct? Oh, because my cost basis is $620, I'm just going to choose that new cost basis to run my covered calls. So why am I saying that's a bad thing? Let me go to the next slide. Right? Market 615, QQQ is now 620. What the pros is, running that covered call at the 620, you were able to generate more premium because you were trading closer to where QQQ is. However, all of that premium from the 625 to the 620, you zeroed it. All of that time you spent, running the covered calls on it, being patient, waiting for them to expire, you threw all of that time out the window. And time is something you can never get back. You can never get back that time. And this wasn't just a financial hit, but mostly it was that time hit. So now that you sold the covered call at that 620, you threw out all of that money from that 625 out the window, doesn't exist, zeroed it. So now you started making money again, right? And then say that, option blows past that 620. Now it's back up to 625 because you weren't patient enough to wait, 1 day, 2 days, a week. You are now trading back at that 625. You could have captured all that premium, but now you were locked in that 620. You made whatever premium you generated for that option, if it was a daily, if it was a weekly, and then so you still made money, great, but that wasn't for me optimal. I would rather just wait for the market to recover because I truly believe the market is like the ocean. You have waves, big waves, it's going to be at that 625, but then after that big wave, the wave goes by, everything goes back to mellow, and now you got that low wave, that's going to be that 615, 620 mark, and then it's just back and forth, and then think about the market slowly goes up. But there's always going to be a regression period. So that'd be the perfect time to, save money or just be patient and wait for the market to go back up. That's what I believe in. You guys don't have to, but it's been relatively successful for me. What is the solution? Just sell the covered call at 625 buying point. Makes trading way simpler. You don't have to roll your option, saving time and money. And what I mean by saving time and money, so say you have that option at that 620. Maybe you run an option at the sell a covered call at that 619. You're like, market isn't looking too hot. Maybe I can get a little bit more premium at that 619. My cost basis is 620. What's the harm in choosing $1 away? But say, for example, that market shoots up. It's past that 620, right? It's at 620. Now you theoretically have, nulled out all of that gain from that 625 to 620. And then now that new cost basis was 620. And then you chose a strike price at the 619. Now you're down $100 of that entire, trading period. And that's bad because you lost all that time and then you also lost money. But of course, people can say, yes, you can roll the option, but what do you have to do rolling an option? The first thing of rolling an option is you have to buy your own option back, which means you're putting up more money than you probably have generated from selling that option, right? And then you have to choose an expiration date that's either further away so you can make the money back that you had to pay to buy the option back. So you're spending more money and you're also wasting more time. So for me, never sell below your buying point. And that's the main reason why, because human instinct is, hey, I want more money. How do I make more money? Start getting more risk. And the way we mitigate risk is just sell covered calls at your buying point. It's that simple. All right. And now let's start talking about guidelines. So since I started changing the remainder of this PowerPoint from rules to guidelines, this is my first one in a red market condition. And the way I define a red market condition is when the stock price is below your buying point. What's the action that I take here is I never sell covered calls below the buying point. We just talked about that. That's the main rule. And what I do in this portion, if I want to generate more premium, is I just extend the expiration. Usually for QQQ or an SPY, I like to run those ETFs as daily covered calls or daily cash secured puts. If the market is super far away, like $5 away, $10 away from where my strike prices are at, I'm just going to choose maybe a week long at a time. And the furthest I like to sell options is a week at a time, because in that week, the market can change, it can recover, it can go up, it can go down. So then it gives you the flexibility to change what your strike price strategy is going to be. All right, guys, for guideline 2, this is for green market conditions. And what do I define as a green market condition? Say, for example, that, 625 buying point for QQQ, it's either at 625 or higher, like 626, 627, 628, and so on and so forth. So what is the action here is I like to choose covered calls $1, $2, $3 away from at the money, as long as it's above your buying point, right? So what does this mean? Is say, for example, we have, that QQQ at that 625. And so for me, whenever you talk about covered calls, I don't think choosing a delta accurately describes how to sell covered calls, because there's two main components. You have the appreciation aspect, and you also have the premium aspect. And there's times where it's on a scale. So there's the market might be trading good. There's high volume, market's trending higher. So you know what? You might want to be biased for appreciation. So what do you do? Say you buy those shares at the 625, you choose a 628 strike price. But by choosing a higher appreciation price, higher strike price, your premium's going to be a lot lower because there's a less likelihood of it hitting. So you're basically trading in higher appreciation for lower premium and vice versa. Say the market's neutral to red and you're like, you know what, my buying point 625, market's been trading around this for 1 or 2 days. I'm going to choose a strike price at that 625, lock it in. I'm going to make more premium. I'm throwing away the aspect of appreciation because I want to take my money up front selling that option. So that's my thought process. So that's why I don't like choosing a delta for covered calls, because there's two main components to it, appreciation and premium. Now let's head over to the next guideline. The next guideline is guideline 3, and this deals with cash secured puts. And for me, I like to choose a delta for my cash secured puts of the 0.25 to 0.3. I only look at deltas for these cash secured puts. And what do I mean by this is, for me to use cash secured puts, all of my portfolio value, that cash value, like $230,000, has to already be tied up in selling covered calls. So I own, a couple hundred shares of SPY or QQQ, 230,000 already invested. But then when I run the covered calls, this is just extra income. So what cash secured put does, it could also be called a collateral secured put. So you're able to borrow against your cash value so that you can generate more income, and you don't incur a cost towards it. Like, you don't incur a margin cost unless the option is assigned, and then you have to purchase the shares. Once you purchase the shares past your cash balance, then it's on margin, and then you're paying the interest while you're owning the shares. But just from the collateral, the cash secured part, you're not paying interest on it for borrowing that money. It's only when you're assigned. So some caveats: I only follow this rule if my cash is used up. I mentioned that. But if the cash is not used up, then I usually like to run cash secured puts higher. So say, for example, my account, it's cash value 230,000, but say I maybe have only $170,000 invested. So I might run a very aggressive cash secured put on the QQQ, roughly $60,000 of collateral needed, but then I'll be able to generate a higher premium, and there's a higher likelihood of those shares getting assigned. And then for the next day, I would have those shares bought, and then I could run cash secured puts now at that 0.25 to 0.3 delta. And for you guys that are not familiar with what a delta is for selling options, it's the likelihood of the option executing. So for 0.25, that means there's a 25% chance. 0.3 means there's a 30% chance. But it also dictates how much premium you're going to generate for every change in dollar. So say, for example, you have the QQQ at the 625. For every dollar, like for a cash secured put, for every dollar the QQQ goes down, you're going to be making 25 cents per share, but that's times 100 shares, so it's $25 per share. So if the QQQ goes down to 624, you made $25. 623, another $25, so you're now at 50. Then it goes down to 622, $75. So that's how options work in general. Cool. Now let's go to the next guideline. For me, this is like yay or nay. This is not a hill I'm willing to die on, but I don't like buying back my options. You made the money, don't give it back. I don't like doing this for covered calls. So let me just read it because I'm going to go off my tangent. If your covered call is getting assigned, let it go. No need to spend money to buy it back and or push the expiration dates. This ties up capital that can be used to produce more premium. And I highlighted this whenever I was talking about the buying point, where, say you're emotionally attached to a stock, you think it's going to go higher, and you're like, oh, I think it's going to appreciate. So then you roll the option because you want to, choose a further away strike price. I don't like doing that. Just let it get assigned away, realize that profit, and then choose maybe a cash secured put to buy those shares back at discount. Markets like the ocean, that point that you just sold those covered calls, that's probably that high point. It's probably going to be a little regression. Run that cash secured put, lock those shares in at that lower point, and then watch it go back up. That's how I view the market. I'm always viewing it going up. And then guideline 4, continued. This is in reference to cash secured puts. Cash secured put is getting assigned. Let it get assigned. No need to spend money to avoid the assignment. Instead, turn around and run covered calls on the newly acquired shares. I just mentioned that. And then this is the one that really gets me, like the 50-50, buying back a cash secured put to then run another cash secured put. So what I mean by this is, say, for example, you're in a cash secured put on the QQQ, but then the QQQ skyrocketed and you can buy back your option pretty cheap, maybe for like $1 or $5. But then you buy it back because you're like, hey, I can maybe make another $50 on this transaction or $100. So then you run another cash secured put. I don't like doing that because then it increases the likelihood of that option getting assigned. And usually, if something blows past your cash secured put that high enough where you have to sell it, what I have noticed in the past is then you're going to there's a higher likelihood of that option getting assigned, and then you're going to get them assigned at a price that isn't really competitive because it's going up that high. It's usually going to come back down. Not the case for all scenarios, but for me, it's 50-50. I'm not willing to die on this hill. Do what you guys think is best for your portfolio. Cool. And last guideline, number 5, I view margin as an investment towards your future. Margin usage is allowed if used responsibly. And let me explain this. For me, I like to use a 1-for-1 dollar amount of my cash to margin value. So what does this mean? My portfolio is at like 230,000 with an extra comma. That means I'm going to use about $230,000 of margin. Some people out there, they think that's too much margin. Some people think that's not enough margin. For me, I think it's just right. And the reason why I think margin is actually a good thing, because let me ask you guys a couple of questions. Would you take on debt to go to school so that you can get a job that's going to pay you an income? Answer is most likely yes for majority of people. Would you take on debt so that you can buy a car so that you can transport to work that isn't going to pay you money? Yes. Would you use a credit card, which is sometimes debt? Not sometimes, it is debt, so that you can buy food, pay for bills, etc. Answer is yes. Would you take out mortgage on a property because you don't have the money so that you can have somewhere to live? Yes. Why don't you take that same concept towards investing? By using more debt, you're able to produce more income. Why wouldn't you use that tool so that you can propel yourself and your family's future further along? And of course, you have to do it responsibly, and that's why you have to follow the 2 rules that I mentioned earlier. And I'm not a financial advisor, but this is my opinion on the matter. If you buy good investments and if you stick to ETFs, SPY, QQQ, you're going to have a good time. Once you start picking stocks and thinking that you can outperform what the market gives you with picking like an individual stock, all the power to you guys. I'm not really into that. I'm just going to choose the winner. If I see anything in the news saying that it's going to get dethroned, I'm going to cut it from the portfolio. I like choosing ETFs because the risk is spread out through all of the companies, top 500 companies in the US versus single stock risk. You are at the mercy of what that stock does. So being tactical with how you use your margin is also very important to risk mitigation. And there's also strategies like having cash on the side. So if the market goes down, you can throw that money in there so you can prevent a margin call if you're using too much margin. Or guess what? Sometimes selling shares at a loss is totally fine. If you've say, for example, for me, I incurred like $30,000, $40,000 in losing those high income ETFs, but then I made $86,000 selling my own options. And then heading into 2026, I now have a good strategy, a good way forward of how to generate more income safely and effectively. That's okay, guys. Sometimes you guys have to get burned by the stove. I'm not advocating you should get burned by the stove, but sometimes it happens. Right? I'm also in a place where I'm young. I'm able to take risks. But if you guys are in a different situation, you guys are 45 years old, you're 55, or you're already retired, maybe taking on like a 1-for-1 dollar amount of margin doesn't make sense. Do what makes sense for your portfolio. Maybe 25%. Having a margin balance of 25% means your account would have to lose almost 75% of its value for it to be a problem, and you getting shares assigned away. So do what makes you also sleep at night. If you have so much margin that you can't sleep at night, maybe you should de-risk your portfolio, one in margin, but also what you're investing in. If you're investing in something and you're just looking at the charts all the time and freaking out if it's going to go up or going to go down, that's probably not a good investment. You should change the investment into something more safer, and that you're going to be able to sleep peacefully at night. Me running this strategy, I sleep peacefully at night and have no problems with it. All right, guys, that pretty much wraps up my rules. But now let's talk about what I plan on doing for tomorrow. What is that? December 29th. All right, guys, before heading over to Robinhood, I'm going to talk about my different buying points. And you guys know me. Whenever I trade my 100 shares of an individual stock or an ETF, I like to consider it an independent silo of money. And what does that mean? Is I'm going to be able to choose different strike prices associated with that specific buying point. So I have 500 shares of Oracle heading into December 29th, and then I have 400 shares of the QQQ, and I have different buying points for each and every single one of these, 100 share sets. And so for Oracle, I have different buying points of the 220, 210, 207.50, 202.50, and this one we actually sold out. So let me delete this. So I have 400 shares of Oracle, And I'm going to be choosing strike prices of 202.50 right now because Oracle is trading below this 202.50. Well, how I plan on selling my options is just choosing my buying points. There's no technical analysis needed because Oracle went down past my buying point. So I'm choosing the 202.50 for one of my strike prices, 207.50 for another covered call, 210 for another covered call, and then 220 for another covered call. Looking at QQQ, I have also 4 different buying points, the 626.78, the 627, the 625.30, and 624. What does this mean? I'm going to choose different strike prices for these different buying points. Because QQQ right now is trading slightly below my buying points it's at like 622, and the market is kind of trading neutral to red. I think the Santa Claus rally is going to be over. At least that's what I'm thinking. I don't know if that's going to happen or not. But it's just from what I'm seeing in this pre-market on Sunday night, that's what it's trending like. So what I plan on doing, at least for 300 shares of QQQ, I'm probably going to run these as weekly. And then for this 624 buying point, I'm going to choose something maybe at a weekly cadence because it's close enough where I can probably make enough money that it's within the range of error, like, $2 or $3. So we'll see. Let's head over to my Roth IRA real quick. And for my Roth IRA, I had 100 shares assigned away of Amazon. So what does that mean? I have about $26,315 of capital available to either buy some shares, run some cash secured puts. And for this week, for my Roth IRA, I'm definitely going to be biased towards selling cash secured puts. I don't think there's as much upside in the market this week. We'll see. I don't know. I'm just kind of talking out of my booty hole. But yeah, I'm thinking maybe cash secured put on Amazon, call it nice and easy. So let's head over to Robinhood and start looking at what some shares might look like, guys. So account is at 233,000. Let's take a look at my buying power and what the situation of my account looks like. So right now I'm using all of my cash. Robinhood will let me borrow about $694,000 of my cash plus margin. And right now I'm only using about $102,000 of margin. So what does this mean? I still have about 130,000 I'm comfortable using before I'm starting to think, maybe I should start, deloading some of my shares. So this event contracts is exactly what I'm talking about. Robinhood will allow me to run about $147,000 against this 233,000. Pretty much no incurred interest costs until the shares are signed, which then bumps it over to margin. So we are going to go shopping. So let's take a look at Oracle. And I've mentioned my 4 different buying points for Oracle. Oracle's trading at this 196.29. So let's hit the trade Oracle options. And guys, this is how simple it is. Oracle is below my buying point, and I'm just going to start ripping different types of covered calls. Expiration is going to be a week long because it's a single stock. So first option, just 2025. Second option, 2027. Next option, 210. And then the final covered call for my Oracle shares is going to be this $12 of premium. Not very great, but off of those 4 covered calls, guys, I'm going to make $327. So that's pretty good. So we locked that in. No technical analysis needed. So let's head over to QQQ. And pretty much the same thing is going to happen for QQQ because guess what? QQQ is trading at this 622.17. And this begs the question, hey, do I want to take my premium up front and push my expirations out a week? Or, hey, do I risk it to see if the market's going to recover a little bit? Is it going to head up to my 224 strike price and so I can run a daily expiration? But ideally for me, when I'm in this situation, especially for, 200 or 300 shares of my QQQ, since it's about $5 away, I'm just going to choose a week-long expiration, call it good. And then for the one that's closer to 622, like my 624 buy-in, I'm just going to run a covered call at a daily cadence. So let's take a look here. Because you can run these options as daily, double check that you run the correct expiration. So for me, let's talk about my buying point of that 624. So this one, if I were to run a covered call right now on this QQQ, I would make $126 of premium. And that looks like a good amount of money. I would be totally fine selling this covered call at that 624, bag that $126, bingo, bango. Or is it close enough where, hey, I might be able to capture a little bit more appreciation. So if I go from 624 to 625, I can bag $100 of appreciation if the market pushes up, but then I would bag $77 instead of $126. So that's the trade-off I was talking about with this scale. You want to choose appreciation. Is the market hot? Maybe you can capture some appreciation, or market's red, neutral. You know what? I'm going to take my premium up front, choose something at my buying point. So that's going to be a decision I'm going to have to make in the morning. But ideally, I like taking premium up front, and because the aftermarket or pre-market right now is kind of weak, you know, QQQ dropped from like 623 down to 622. I'm going to side with taking my premium up front. So let's lock that in, $126. So boom, there we have that. Now let's take a look at an expiration for January 2nd. So yeah, like I said, guys, we only have 4 trading days this week. Let's head over to closer to where the market's trading. So the next closest buying point was that 625.30, but because I like to round up, I don't like to round down, I would choose a strike price of this 626. So running a week-long expiration on QQQ at this 626 strike price, $226. Now I have another 100 shares at the 627, and then I also have 100 shares at the 626.78. But ideally, I don't like choosing multiple strike prices that are the same, so I will just ladder them out. So in this circumstance, I'll probably just ladder out to that 628. So then running those 4 covered calls on the QQQ, guys, I would bag, you know, $716 plus that, you know, 300 something dollars of Oracle shares of Oracle covered calls. Guys, we already hit $1,000 for it. It's going to be the 17th week in a row on a Monday. And then I can wheel and deal covered or cash secured puts throughout the week so I can generate more income. So now that we have that off the table, guys, bingo, bango, let me close these out. Let's take a look at what a cash secured put looks like. And for cash secured puts, I really only like running these dailies. I don't like running weeklies at all. So let's hit that cash secured put, QQQ trading at that 622.48. And for me, guys, because pretty much most of my capital is tied up in cash, I'm going to choose that delta of that 0.25 or 0.3. The 622 strike price is already at that 0.29. Let's see what that 21 is. This delta is a little lower than I like. So it will be a game time decision of this 622 versus that 621. But because the market's a little bit weaker, I'll probably choose that 621 and bag $46 of premium. So I can probably run 2 cash secured puts at this rate. So, but I don't like doing that. You guys know me. So I might just run another at this 620. Or it begs the question, do I just run 1 cash secured put on QQQ and then maybe I run something on an individual stock? For me, I'm a big fan of Amazon. You guys know me. You've seen me trade this quite often. That is not what I wanted. All right, you guys know me, Amazon. Let's take a look at where we're at. Amazon is trading at that 231.90. So let's look at trade Amazon options sell put. This is going to be a weekly cadence, weekly expirations because it's a single stock. And so I'm going to talk about this for 2 ways. Let's talk about for my Roth IRA right now, because my Roth IRA only has about $26,000. You know, I could either buy 100 shares of Amazon at this, you know, 232. So I would need about, you know, $23,000, or I can run it on IWM. Ideally, the premium is better for Amazon. And while my account is relatively smaller, I'm probably going to be more biased towards premium upfront versus stability in the long term. And I'm not really a fan of the small caps in IWM. It's not the market leaders. It's not the market winners. These companies aren't having billions of dollars of revenue. So for me, I would rather choose a company that does have $1 billion of revenue and is actually consistent in performing. Amazon is that stock. We could even look at Google. But for my Roth IRA, I'm probably going to run a cash secured put. And if these premiums are, that's so called, do a sell put. If these premiums are like this 230 strike price doesn't seem bad. Delta 0.32. Take a look at this 227.5. Delta 0.19. This is a little bit too low. I wouldn't mind getting 100 shares of Amazon assigned to that 230. I recently just sold them for 230. So theoretically, they would kind of like null themselves out. So ideally, I'd probably run 1 cash secured put on Amazon at that 230 strike price, call it good. And that's going to be the only trade I run for my Roth IRA. But let's talk about back to my brokerage. For my brokerage, I probably would choose a strike price a little further away because I'm already tapped out and a little bit more. I have some margin already incurred. So I could run that QQQ cash secured put, and then I have, another $60,000 I could run for cash secured puts. I'd probably choose this 227.5, bag another $63 there. But then I really want to see what Google has been trading like. I want to start trading a little bit more Google. It's definitely a market leader. I really don't know the difference between the A and the C, but we'll take a look. Let's look at trade Google options sell put January 2nd. Yeah, for a nice $30,000 of capital, make $116 a premium. See what that delta looks like, 0.2365. Guys, I might do that. Run a cash secured put on Google 307.5. So heading into tomorrow, guys, we have quite a bit of options. Let's just look at what IWM is offering. I know you guys like that too. Let's see. IWM at 251.30. I would be aiming for IWM in my Roth IRA. So let's see. I think the premium for IWM, if this is $46 for a daily, I might do that. See what a week-long expiration would look like. Probably would choose this 250 strike price, bag $103 of premium. Interesting. I think I'm more biased towards Amazon. I'm more familiar trading with it. But IWM is never a bad bet. Maybe I run one IWM in my brokerage. We'll see. But yeah, guys, that pretty much wraps up the video. When it comes to choosing stocks, maybe my channel isn't the best for that. But for me, I'm just harping the point of, choose your market leaders for me. Amazon, Google, those are usually my big ones. Oracle is definitely a big position in mine, but ideally most of my trading is in the ETFs, QQQ, SPY. I like to lock it in, keep things as simple as possible. But yeah, guys, if you found value in what I was talking about today, please do not hesitate to like, comment, subscribe. That would mean the world to me. I love making these types of videos for you guys, and it gives me more motivation to see that you guys are actually liking it. You're leaving comments, and I appreciate the support. Matt out. We'll see you in the next video tomorrow, and let's make this money.